bear with us when we screw up and mess up and talk too
Speak
fast.
for yourself.
I'm going to introduce you to my wife and to my son today. We're going to explain the different things about first-time home buyers. And Cheryl got into the business in 1982. And the reason she got into the business is because she wanted to buy her first home. She found this beautiful little California bungalow in Long Beach, and every agent told her she couldn't buy it. There was some reason why she couldn't buy it. So she was determined to buy it. And so she got a real estate license so that she could buy the property, and she found out a way and purchased that property. I don't know how long it took her to do it, but that was the reason she got involved in real estate, and she's been a full-time real estate agent ever since, for 25 years now. When we met in the early 90s, she explained to me the benefits of owning real estate and how she would find ways to help her clients become wealthy through real estate. And it was so eye-opening to me that it made a decision for me to transfer from the business that I was in into real estate to do what she does for her clients. We also, my son has just joined us in the real estate business. He has been a banker with Chase Bank for the last 8 years. He has his license in real estate now. He has his license to sell mutual funds and securities. He has his license to sell life insurance. He has his license to sell
Long-term care, long-term disability, health insurance.
Right there. A lot of licenses. Do you have the driver's license?
He goes to Las Vegas for fun a lot of times. So I think he almost has his gaming license as well. Don't tell him this, but it's kind of scary how intelligent and how how accomplished this guy is already. And he's only in his early 30s, so it's scary to me. But I'm going to introduce my wife now, who's going to talk about the first-time home buyer program. So, Cheryl?
We also have a middle son you forgot about.
Oh.
Right,
Yeah.
who's working today.
Couldn't get to him later.
Prepared all the sandwiches for us. He'll be starting full time after today with his job. So, and I got that house because they couldn't figure out how to get me qualified because I didn't have a full-time job down here. I had moved from Northern California. And so my mom and brother were qualifying for me, and then just before they were going to do the loan, they checked my brother's credit, and he was paying child support, so that threw that out. So I went to this house, which was now vacant, and I said, wait for me. Just wait for me. And I got my license in like 2 months, and I was champing at the bit to get in. And I remember thinking, how am I going to get this house? And I mean, I did everything, and I remember right down to the very end, at that time, we needed to have termite clearance, and the owner wouldn't pay for it. And I thought, I am not going to be blown out of the water. So I called, I used to do, I had an ad agency in Northern California, and I used to do trades with advertisers. So I called Rose Exterminators. I never did a trade with them, but I thought, what the hell? I called Rose Exterminators. I said, listen, I'm going to put out newsletters. I'll feature you. I'll do an article. Will you do my termite clearance? It's $1,700. It's sure. So I got that taken care of. So now here's the deal. Where there's a will, there's a way. I'm a problem solver. No matter what the problem is, no matter what the obstacle is, we will overcome it. So there, whatever it is, do not worry. Got a great team here, got a great lender here. We can overcome it. So now, what we're going to do first of all is we're going to talk about what we hear all the time. We always hear, as agents, I don't have enough money to buy a house. Or, I just can't afford the monthly payment, it's cheaper for me to rent. Or, I don't have my credit's just not good enough. So we hear this all the time. So what I'm going to tell you is a little tiny brief story. We're going to go back to I just did this morning because I was just too quick before I looked at my stuff yesterday. I just did bullet points. I want to give you a little story. Back in 1925, you could buy a house for $2,200. And that's if it was already built. You could buy a prefab or a pre-built or an unbuilt house from Sears that you could build yourself for half that price. And they would send it to you and you still had to pay for it. The average worker made $1,850 a year. So a little bit different time. However, if you bought a house, financing was 50% down. It was financed for 3 to 5 years with a balloon payment at the end. Not really a good deal. So that's how housing was at the time. 4 out of 10 people owned a home. Most of them bought cash if they could afford it. Then 1929 came along and the stock market crashed. And that crash started the depression, which went along for 10 years. Now, in those 10 years, that mess was worldwide. And we in the United States were just going down and down and down. And by 1934, Congress enacted the FHA, Federal Housing Administration. And they did that because 2 million construction workers were out of work. Nobody could get a loan with those terms. Nobody could buy a house. They don't have no place to live. And, well, the housing industry was primarily flat on its back. So when FHA came into fruition, terms were relaxed. By the 1940s, after the vets came back from the war, FHA had housing. They financed all the war housing, all the housing for the veterans. In the 50s, 60s, and 70s, they had housing. They had privately owned units, apartment units, for seniors. They also had it for disabled, and they also had it for underprivileged. FHA has been going on and on and on, helping lower income or middle income people for years. In 2001, they had reached 68.1% housing for America. That computes to, where is that figure? Where are you? 38 million houses in America and 48.5 million units. FHA will finance single families and 2, 3, and 4 units. Slide. Who can apply for an FHA loan? Pretty much anybody. If you don't already have an FHA loan, if you have a low credit score, which is good for people who don't have a high credit score, of 580. If it's below 580, you can get in. 580 will give you 3.5% down. If you have less than 580, say 500 score, 579, you can get in with 10% down. If you can't apply for a conventional loan because of bankruptcy or foreclosure, FHA may also finance you. You have to talk to a lender about that. If you don't have any credit, and you have to have credit if you go conventional, you can talk to the lender because they can use other means to get you credit. They can use other means, maybe you're a landlord, you pay your rent on time, things like that. FHA is fabulous for low down payments, 3.5%. Conventional is 20%. I'm going to use a $400,000 loan amount as we speak throughout here because $400,000 is probably about an average what you're going to pay for a house. You can get lower. You can get maybe $300,000 depending on where you go. You can get townhomes, condos. You can, if you can't do that, we can break you into a duplex. You can pay more, but the rent on the other duplex will have to qualify. There's a lot of things that we can do to get you where you want to go. But low down payment instead of 20%, 3.5%. Relaxed credit requirements. So I already talked to you a little bit about credit. Lower interest rate. Right now, I think the last rate I saw was 3.6. It goes up and down. Credit moves all the time, so it goes up and down. Our lender, when you're in escrow and your credit when credit drops to the right number, the interest rate drops to the right number. Like you say, you go in at 3.6. If it happens to drop to 3.5, Tom will lock it. because it's a better rate. If you go in at 3.8, it drops to 3.6, Tom will lock it, because he wants the best rate for you. Right now, on average, I would say on a conventional, you're lucky to get 4, probably 4.25, 4.5. Big difference. You're putting down 20%, big difference. So on a $400,000 house, you're putting down on conventional $80,000. On FHA, it's 16. So you can do the math. Reserves. You don't need reserves on FHA. In other words, with a conventional loan, you need 4 to 6 months in the bank in case something goes wrong, you can make your payment. You don't have to have reserves with FHA. So if you're strapped for cash, or you have little cash, yeah,
No, I'm sorry, isn't it FHA loan for first-time buyers only?
it's for everybody.
Oh, anybody.
Anybody. You qualify. Okay? You can, and I can get an FHA. I can't. I own too much. But my son can get it. He doesn't have an FHA loan. You know? If you're making $80,000, $90,000, $100,000, you can get an FHA loan. Am I correct? Correct. So you're good. Okay? If you're not making that much, you're still good. We'll get you qualified. See what you qualify for. Good. I'm on my own now. That was it. It's a little short intro. Closing costs. You're going to have closing costs when you buy. Sometimes with a lot of times with a conventional loan, you'll come up with, sometimes you'll buy the loan down, you pay a point to buy the interest rate down. A lot of times with FHA, you'll also have closing costs. Tom will work out where you're going to have a credit for closing costs for the most part. He'll really does a phenomenal job with our clients in getting them the best rates and closing cost credit, which makes me so happy because they never have enough money. And we together we're a phenomenal team. We did a deal. We did this deal with a guy who we wanted to buy a property that was priced at $290. We were trying to get him up to $280, and we did everything for 3 weeks that we could possibly do to get him to $280. We wanted him to sell his car. Couldn't get that car sold fast enough. We wanted him to prepay a debt. We couldn't get that debt sold. So finally, I said to Tom, "What does he qualify for right now?" And Tom said $260. I had been talking to the listing agent, my son and I said to Sam, "Let's make the damn thing at $260. Let's just make the offer at $260. So he wrote up the offer. He says, "Mom, we should write a letter to go with this," which is a great idea when you're doing a house. So he wrote this great letter from the buyer. The buyer wrote it, talking about himself, and I added a little bit about, buyers always forget this, you have to talk about how great the house is, because they really want to know how great the house is. They accepted. They accepted that offer. Then we had to go through all kinds of other things to make it work. And we did. Unfortunately, it didn't go through because the buyer's mother hated it. And he wanted his mom to come and stay for a while, and he was some "Mom, I love you, Mom" kind of boy. So we're now looking for another property, but we'll get it for him. It was incredible. So, but we can do things that sometimes we'll look at each other and go, "How do we do that? How do we make that work?" You just keep chipping away until you make it work. Now, increased allowance for closing cost financing. Larger income to debt ratios. With a conventional loan, you've got a smaller, you can't have too many debts. They squeeze you on it, but with FHA, you can have a lot of debt. And Tom will work it out on how much debt you can have. And we will work with you to make it work for you. And then FHA loans are assumable. So if you sell it, your buyer can assume it. However, if you want to buy another FHA house, and that one's assumable, you cannot buy another one while that one's still against your name. Am I correct? So, next slide. There are drawbacks to an FHA loan. They have an upfront mortgage insurance of 1.75%. In 2012, it was 1%, but now it's 1.75%. And they also have a monthly, yearly, annual mortgage insurance. And if you put down 3.5%, that comes out to 0.85% per month. And then also, not all condos and townhouse complexes are FHA approved. So you may not be able to get a townhouse, you may not get, well, you can get them, you've got to find it. We find them, okay? If we don't find them, we find them. We'll get them, so don't worry about it. We'll find a way to make it work for you. Now, upfront mortgage insurance is built into the cost of the loan. You don't have to come out of pocket for that. 1.75% goes into the loan. So there's a little bit more on the loan, not much, it's maybe $5,000 or $6,000. The monthly is in your payment. So you say, okay, why do I have to pay that? That's the next slide. Is it the next slide? Yes, see? Because they take so little down, 3.5% down, $14,000 on $400,000. They take so little down that if in fact somebody defaults, they take that money that you paid and they make sure that that lender doesn't take a hit on that defaulted loan. FHA is not funded by taxpayer money, it's self-funded. So all the money that they collect goes into a fund to take care of these defaults. When the market crashed in 2008 and 9, a lot of people walked away from their mortgages because they had very little skin in the game. If those were FHA loans and they only had 14,000 or 6,000 or whatever, and they said, oh, my house dropped. Now, psychologically, if you paid $400,000 for your house and it's now only worth $2, you don't want to make that payment anymore. You think, I'm paying too much. Had you kept it, had you just kept making the payments, as you can see, it has gone up in value. We bought a fourplex in 2007 before the market dropped. Fortunately, with fourplexes, people are paying rent. We didn't care if the market dropped. We paid $1,065,000. In a year, it was worth $900,000. We said, oops, it's only worth $900,000. But we rehabbed the property, we got the rents up. We were collecting about $200,000, excuse me, I wish, $2,000 net per month, net to us per month, plus another $300 on the laundry per month. So if you can, buy a duplex, and you can, we can work it out for you. So there are drawbacks, but in the long run, next slide. Oh, let me do it. Before I tell you why it's still okay to pay that insurance, let's talk about how the payment looks. On an interest rate of 3.6, because you can't see it here, you've got a $400,000 loan.
No, price.
$400,000 price. Thank you. Just gotta watch me because my mouth jabbers. $14,000 down. Now here's your 1.6. Here's your subtotal. It's $386. Normally that would be your loan amount, but you add in that 1.75% mortgage insurance up front is $6,700. So your loan amount is now $392. That's what's being financed. So your payment on that amount is $1,785 a month. That's how much your payment is. It can get better. It will get better because we're going to show you how. We're going to get help for you to make that payment. Go ahead. Sam will show you. Mortgage insurance has those two components: your upfront, which is 1.75, and your monthly, which is 0.85. How can you get rid of it? Normally, with the prices going up the way they are right now, within a year, maybe a year and a half, the property will have reached an 80% or a 20% equity. You can refinance it. And you can do a streamline, no points, no costs, no nothing. Boom, you streamline that, get rid of the mortgage insurance, get a new loan on there, and it's gone. You no longer have any of the mortgage insurance at all. It's gone. You're now down to a $79 payment. Here's how it goes. Here's what that looks like with the total here. Don't panic yet, okay? Because it gets better. When you get rid of that, you're back to this. With it, you're at $2,063. Okay? When you get to about $500,000 on a $400,000 loan, is when you can get there. How do you know when you get there? You call me. I answer my phone almost 24/7. Seriously, my husband yells at me, why are you answering that? Because you want more clients. So I'm always answering the phone. You can text me, I get back to you really quick with a text because it makes a louder noise than my phone. Okay? Here's where the good news comes. Sam's going to tell you how you can afford the payment, because he can tell you how the government is going to help you subsidize that payment. Take it away, Sam. He gets the good part. I'll say the bad news.
I can't afford the payment. How often do we hear that from clients when we're looking to get them a new home? Next slide, please.
You went all fancy with it.
So the first question is, why buy a home in the first place, right? I'm a renter. Why should I go buy a home? I can't afford the payments. Well, the biggest advantage to owning a home is it's a tax write-off. So I'm going to show you how it's a tax write-off. You can write off the mortgage interest. You can write off the mortgage taxes. Get that back or not pay it in the first place on your mortgage loan. That's next, please. So homeowners enjoy much different and better tax breaks than a renter does, because that mortgage interest can actually be taken as a tax write-off. As opposed to paying rent, you can't write that off. So most of us know what is a tax deduction, but just stated simply, a tax deduction is simply an expense that you can subtract from your yearly income off your tax return. All deductions reduce your taxable income, thus lowering the amount you pay in taxes. So the beauty of this is, when can I take a tax deduction when I buy a home? Mortgage interest is the biggest one that you can take. And there's a way you can take it monthly on your monthly payments. So think of it this way. You're making those monthly payments, the ones my mom showed you earlier. You can take a deduction on a monthly basis that would effectively lower the amount you pay each month to your mortgage. Mortgage points are also another big deduction that you can take. Mortgage point, stated simply, is something that you pay to either reduce your rate or get a favorable term on your loan. Tom would be better to answer that question if you have some more questions about that. Something important to note about a mortgage point, it's something that you pay on the year that you get the loan. So you can't take it on a every single year tax deduction. You get the tax deduction on the first year you purchase that house. So each year you can deduct your property taxes. Normally when you own a home, your property taxes are put into a side account when you make those monthly payments. And at the end of the year, you can tell your accountant how much that is and get a tax deduction from that each year. And that's ongoing.
And also the bank will send you a statement
That's
showing
true.
you. That's
Mhm.
how I get mine.
Yep, they send you the
Very
mortgage interest.
precise.
Mhm. So here's an example. So let's use the same home that we talked about earlier. $400,000 home with this should say 3.6%. With an interest rate of 3.6%, you'll pay approximately $16,000 in mortgage interest on your first year alone. You will pay about $5,000 in property taxes. So another question we get is, how can I get this down payment? I haven't saved enough, or my money's tied up in my retirement. Can I access that? Well, actually, there is a way you can do that. So you can take money out of your IRA without a penalty from the IRS. So typically when you take money out of your IRA, there's a penalty if you take it out before the age of 59 and a half. If you take it out for the purpose of buying your first home, you can avoid the 10% penalty on the funds. Now your funds are taxable as regular income, so they'll be added to whatever you made during the year. And the limit is $10,000 on the traditional IRA. Keep in mind this is different for if you're in a 401k, you'll have to check with your 401k company. They do it a different way, it's not under these same rules. So an example with a $400,000 home at 3.6% interest. Let's say you're in the 25% tax bracket. Everyone's tax bracket's different, but we use this as an example. The mortgage interest will be approximately $16,000 for the first year, and your property tax is $5,000, we said that already. So you'll receive approximately $4,752 back on your itemized tax return, or you can change your payroll deductions to get that on a monthly basis. So that's what we were talking about earlier. If you're a W-2 employee getting a paycheck, you can take a bigger deduction on your monthly payroll and actually keep that money up front so you don't have to wait for it to come back at the end of the year, thus using it for your monthly mortgage payments. So here's one of our worksheets that we use here at Continuity. So this one actually breaks down your tax savings based on your tax bracket. So we enter in here your property taxes, the tax bracket we estimate you may be in, and we can actually get a monthly figure. So for that same example, it comes out to $396.20 every month that you can contribute towards your monthly payment. The next one is my FICO score is too low. Oh, I hear that a lot too. So there's good news if you're looking to buy a home and you have what you may consider poor credit. It's probably not that bad. So one, get the FHA loan. If your FICO score is 580 or higher, you actually qualify for the 3.5% down payment on an FHA loan. But let's say your FICO score is a little lower, 500 or 579. All you would need to do is put up a little bit more money down, and you could still get a mortgage loan and still buy your home with only 10% down. So credit scores for conventional loans actually vary by lender. That's why FHA is the route to go. If you have a challenge like a credit score or a low down payment, FHA is the best route to go to get that loan. Typically with a conventional loan, they may want a credit score of 620 or higher. And actually I've seen some that have even a higher requirement than that, with 20% down. So to sum up what we talked about today, FHA empowers first-time home buyers to put down 3.5 down payment if you have a FICO score of 580 or higher, 10% down payment if you have a FICO score of 500 to 579, flexibility to use IRA funds and also gift funds to make your first purchase, and you can save potentially thousands on your tax write-offs. So that's the end of my presentation. So Mom, if you'd like to come up.
Yeah, one other thing too, I was talking to Tom about whether you could write off your PMI for tax deduction. And Congress is still out on that, and we're waiting for the tax code for this year. If you can start writing off your PMI every month, that'll give you a huge tax deduction, and the way things are going, that might just be put into the tax bill. From what I've been reading online and everything, there's just out on it right now. They haven't made. Last year was it, and they're just waiting to see if they're going to renew that. So, you know, a couple of $100 a month, or $300, whatever it ends up being, is a lot of money. And if you can write that much more off, you'll get that much more than you can keep. So, and that's money that is taken out of your check that you have no other way to access. So it's money that's valuable and accessible to you. So it's questions. We have a lender here for you. Anybody have any questions?
What is PMI?
PMI, private mortgage insurance. Yeah. Or mortgage insurance premium, yeah. So, but yeah, that would be good if you can write more you can write off, the better. You know.
I've been hearing a lot about lately how homes prices have gone up here in LA and very low in inventory. And someone said, Susie, just wait, because it's coming down.
It's not coming down.
I don't think so either.
No, the inventory is very short. I mean, when they're in short supply, it's all about supply and demand.
Right.
So we find other ways for you to buy or buy different things. If you don't buy, you don't ride the wave, and the wave is going up. So if you can get in now, it's just starting. If you can get in now is the time to get in, because then you ride it as it increases in value.
It's still going to keep increasing.
It's increasing. If there's no supply, do you think it's going to go down?
No, I agree with you
No.
that I know
It's
that
all supply and demand, yeah.
Yeah.
So yeah, everybody wants to wait and for that things to come
I'll
down.
wait for what? I don't,
Yeah.
yeah. I think I've been waiting for 5 years.
Wait more,
Right,
yeah.
that's what we're talking about.
Yeah.
Yeah.
The unfortunate thing about waiting is that as you wait, so prices keep continuing to go up, and you're not in the market. You know you're paying rent every month. Susie is one of my renters. She pays me her rent every month, and she gets no benefit from that apart from
But you could afford
having somewhere to
this.
live.
Oh,
Okay.
we're
Yeah.
You
that
can
we can easily
Yeah.
afford.
And besides that, I'm sorry, honey.
What?
Besides this here, you're appreciating in value. The property is going up in value. And when you own a home, there's an intrinsic value of being able to do whatever you want to do. I bought my first home for one reason, to have a cat. Because no landlord would
Mine's to have a dog.
See?
Because I want a dog.
Yes, just to be able to not have to. My first house was a little condo. Nobody would rent to me because I wanted to have a cat. They didn't want a cat as a way back. So I bought a condo to have a cat. That was my reasoning. I had a friend, the guy, he said, oh, but you have tax write-offs. What were those? I just wanted a cat. So the whole idea is you can paint your house black. We have a neighbor across the street that did that. I like it. Nobody else does. But it looks pretty cool. And I told her the inside's hot pink. That's not so cool. But at least it looks kind of nice on the outside.
But it's there, so they
It's
can do
there,
whatever.
so they can do what they want, you know? You own it. Nobody can tell you what to do, where to live, how to decorate, you know? When I was building during the recession in '08, I had to stop building because I ran out of money. My neighbor next door went to the city. She can't do that. And they said, shut up. I could do whatever I want. I couldn't continue building. They said, well, all the possums are coming. Oh, please, possums are everywhere. So I got to building again when I could afford to. They can't tell you what to do. They can't stop you from what you're doing. Unless, of course, you've got 1,000 cats or you've got garbage everywhere, you know, you're a big eyesore. I was just halfway built. Couldn't do anymore. So it's yours. And there's a something inside of you that happens when you own it, aside from all the other benefits that you get from a house. It's your dream. So
And one last thing, huge fear is what if somebody, $400,000 house, that's a pretty low range for the area I would like to live in. And so what I would get for my money, maybe it's an investment, maybe I can increase that later, but I'm terrified about plumbing issues and things gone wrong,
here's what you get. You get a home warranty, and the seller pays for it. And that covers all the electrical, heating, and plumbing that can go on in the house. And it's good for a year, and then you renew it. And the cost is about $500, $550, but it beats plumbing costs.
Yeah.
So you can get a home warranty, and anything else.
Those plumbers come out and they fix anything for $60.
Yeah. So
It costs you $60 for the person to come out. We've had people's water heaters go out,
Ours went out.
and they're about $1,000, $1,500, maybe $2,000 depending on the size to get it replaced. With the home warranty, they replace it for $60.
Wow.
We were here 2 months. We had a 50-gallon water heater, which was in around like $3,400, and it cost us $60.
$60.
It went out.
They're worth it to have.
Yeah.
If you have a property, because you haven't lived there, you don't know what the problems are with the
Right,
house. The seller may disclose things on the TDS, but you don't know, you haven't lived there. And so having the warranty is security to know that, within a year, you're gonna find out all the problems of the house, the
You'll
situation.
also, a TDS is a transfer disclosure statement, and you'll have a home inspection before you buy it.
Yes.
And then we'll negotiate repairs before you move in.
Yeah.
So that you don't have to worry about all those little things.
This woman amazes me every day.
Oh, he loves me.
Not just because she's beautiful and she's my wife, but this is one of the reasons why she got me to come out to leave a business that I loved. I used to dance, and I love dancing. She got me out of that business and into real estate because of what she does for her clients. And we're not just real estate agents, we are financial advisors through property. We don't just try and sell you one house. To us, it's a stepping stone in your wealth building through property investment. The house may not be, the first one you buy, it may not be in the area that you want to be in. It's not your dream home. But it's a stepping stone to that dream home. And we want to be there the whole way along that journey to get you to where that's a dream house. And then have your dream house pay for your retirement, to set up your investments in other properties that are going to give you passive income to set up your retirement. Okay? So it's not just a one and done deal for us. It's a relationship that we want to build with you and see you along your way to wealth building.
It may not be your dream house. Do you remember that one little guy that was working 2 jobs and I wanted to get him into the manufactured house?
Mm-hmm.
There was a little guy that came in about 2 years ago. He was a referral from a lender, and he was working 2 jobs. His wife didn't work. He had 2 boys, one in high school, one in college. And all they could afford